So we've got two more learning objectives to cover in this chapter. We went through and talked about sale of ordinary assets, which remember are inventory, accounts receivable, notes receivable, that sort of thing. Short-term depreciable assets, so those assets that have been held for a year or less, exactly a year or less. And then we went through, talked about capital gains as well, which we call our investment property and personal use property. If it's personal use property, we don't get to recognize any losses on them, on those capital, those items. But we went through and talked a lot about the capital gains, lots of aspects to that. We've got the short and long versus long-term capital gains. Remember, short-term capital gains have a special tax rate, special lower tax rate, the same tax rate as the dividends. So that's 0%, 15%, and 20%. There's actually also a 25% capital gains tax rate, which we talk about in this next section here. When we talk about business property, they call it a capital gains tax rate, right? Because it's where it's reported. And what else did we talk about with regard to capital gains? With that netting of the capital, the short-term and the long-term capital gains, and putting that all together, the fact that any losses, any net losses for individuals can be, you can use up to $3,000 to offset other income on your tax return. If you have more than $3,000 of losses, that gets carried forward to the next year. It retains its character. So if it was short-term, it'll be a short-term loss. Long-term, it'll be a long-term loss. But that gets carried forward indefinitely into the future until it's absorbed, or until you die, in which case it's gone. But then you don't care anyway. What else did we talk about with regard to capital gains? Yeah, so I know there were other things that we talked about too, but just off the top of my head. So just kind of a little recap on those capital gains. So the last type of asset that we want to talk about with regard to the disposal of is business property. And here we're talking about long-term business property, depreciable. Well, it could be depreciable or non-depreciable. Non-depreciable would just be land. But business property that has been held for more than 1 year, because remember, if it's held for less than 1 year, then it's considered ordinary income property, and we're going to report it on page 1 of that 4797. Everything, all of this stuff gets reported on the second half, the other side of the page 47, the form 4797. Remember, these are called 1231 assets. Those capital assets are called 1221 assets. We didn't really have a name for the ordinary income ones because they kind of come from different parts of the tax code. But these are referred to as 1231 assets. Again, how we treat the sale depends on whether the asset was sold at a gain or a loss. If it was a gain, whether or not the item was depreciated, and whether the asset was real property, depreciable real property, or depreciable personal property. So again, distinction between that. Real property is real estate, buildings, that sort of thing. Personal property is pretty much everything else, equipment, autos, furniture, furnishings, that kind of thing. We have to net them, the gains and losses, but it's not quite as complicated as the capital gains netting is. So if a net 1231 gain results, so if you net all of them together and there is a gain, then the gain is going to be taxed at long-term capital gain tax rates, except for the depreciation portion. Okay, if there was depreciation, but that all those long-term is going to all those long-term gains then are going to get that special tax rate treatment. The depreciation though, and we talked a little bit about this on Tuesday, we went through a calculation. depreciation, how that works, any portion that is attributable to depreciation is subject to that recapture, because again, you got the benefit of offsetting higher tax rates, presumably, when you depreciated the property. And so when you go and sell it, you shouldn't then get the benefit as well of lower tax rates when you got income from it. So it's to kind of try to equalize that. So those gains have preferential tax rate treatment, except for the depreciation portion. If there is a loss, then that loss is treated as an ordinary loss, which is kind of nice because it offsets ordinary income, and there's no $3,000 limit on that. With capital gains, remember those losses were limited to offsetting $3,000 of ordinary income, other income, wages, interest, dividends, and all that other stuff. So it would reduce up to $3,000. But with the 1231 assets, when we have a loss, there is no limit to what that loss could be. So it can offset more of your other income, okay? Again, we're going to use that 4797 when we're completing this. So let's look at an example here. Yen sold land used in a trade or business for $15,000 in 2023, purchased it in 1992, so it's a long-term asset, for $7,000. So there's an $8,000 gain. The gain from the sale of that, because it's part of a trade or business, is going to go on the Form 4797. If it was an investment, it would go on the Form 8949 and then be transferred to the Schedule D. If it was a piece of inventory, like they're in real estate business and they're selling land and that's what their business does, that would go on the Schedule C. So as ordinary income. But because this was land that was used in the business, the sale of it's going to get reported on the Form 4797. The $8,000 gain is going to be netted with any other 1231 transactions. So anything else that he sold during the year and had other gains or other losses, any of those other 1231 type transactions, it's going to net together. So the gain of this, so it goes on the 4797, but then it gets transferred to Schedule D as a long-term capital gain, because it's getting transferred to that because it's got those special tax rates. Okay, so all that stuff on the long-term items on the Schedule D are there because they've got a special tax rate. If they result in a loss, the loss on the Form 4797 is transferred to line 4 of Schedule 1 as an ordinary loss. So that's also where all those adjustments went. So it's going to reduce adjusted gross income as well as offsetting that income. It's going to reduce adjusted gross income, which could also impact a lot of other things then on the tax return, right? Because that AGI is affected by or affects a lot of other credits, deductions, and those sorts of things. All right, so this is kind of a flow chart here to separate this all out. So when you sell a 1231 asset, you might have a gain or you might have a loss. If it's a loss, it's pretty easy. It's an ordinary loss. It's going to just offset all of your other income on your tax return. There's no limit to it. If it's a gain, there are 3 different ways that it could be recorded. So this, and we're going to go through these. 1245 recapture, both of these have to do with depreciation. Depreciation that was allowed or allowable, that was taken in the past, or you were entitled to take in the past, even if you didn't. That is what this recapture is about. 1245 refers to personal property recapture, so equipment, furnishings, that sort of thing. 1250 recapture refers to real estate recapture, okay? Or we may just have the 1231 gain, which is not the recapture portion. It's the appreciation, right? How much did it appreciate in value? And we'll go through, there's a lengthy example here in this chapter to show you. Let's see. All right, so that recapture part. So depreciation recapture, again, that's the amount of gain that is due to depreciation. So you got some sort of depreciation adjustment over the years, and you got a tax benefit from that because that was a deductible expense, but it reduced the basis of the property. And then when you went to sell it, you had a gain, but it was due to the depreciation that you had taken on it. Okay? So the longer the taxpayer owns and uses the property, the more cost is recovered in the form of depreciation. So that adjusted basis is reduced. The lower the adjusted basis, the greater the gain, if there is a gain, that would be included in taxable income. So again, position of the IRS, if a taxpayer was allowed to reduce taxable income by taking a depreciation deduction and paid less in taxes, when the property is sold, some of that gain that's attributable to depreciation deductions should be taxed at regular tax rates. So again, this is called depreciation recapture. So we recapture it as ordinary income. So for personal property, 1245 property that was used in a business had depreciation, allowed or allowable. The gain attributable to depreciation is taxed as ordinary income. So whatever your ordinary tax rate is, if you're in the 22% bracket, it's going to be taxed at 22%. If you're in the 35% bracket, it's going to be, and this gain gets you into is in that 35% bracket, it's going to be taxed at 35%. This is only the depreciation portion. Now, of course, you may have been in a different tax bracket when you actually took the depreciation. So it's not going to completely equalize, but that's the theory behind it, that you got a reduction of ordinary income when you took the depreciation deduction. So now if you are realizing a gain on that sale, the amount that was attributable to depreciation should also be taxed at ordinary income. Does that make sense? At those ordinary income rates. You shouldn't get a special lower tax rate because you got a break at ordinary tax rates when you took the deduction. Questions about how that whole concept? It's confusing. So let's see. And I know I put an example up before, but we'll do it again. So let's say it's 1245 property. So section, I don't know how to do that little sign. Section, I guess it's 2 S's. 1245 property, and the original cost was $10,000. So a piece of equipment or a piece of furniture or something like that. And then you owned it for maybe 3 years, okay? So you took 3 years of depreciation on it. You got to, that depreciation lowered your taxable income during those 3 years, right? It was an expense. It was a deductible expense. It lowered your taxable income. So let's just say that was $5,000 of depreciation that you took over those 3 years. So over those 3 years, your income was $5,000 lower. Your taxable income was $5,000 lower because of this. And it reduced your ordinary tax rate. So if you were in the 22% tax bracket, it reduced your taxable income by 22% of $5,000. So let's just say that you sold it after those 3 years for $12,000. Hardly ever happens when it's equipment or furniture, but let's just say we've had a lot of inflation, so we'll say that you actually made some money off of it. Maybe it was a car. Used cars are really expensive right now. So you sold it for $12,000. Well, if you were, so our basis here, right, is, I should put that, basis, our adjusted basis is how much? How much is our adjusted basis at this point? $5,000, right? All right, so if we sold it at $12,000, obviously we have a gain, right? Between those two. We sold it for 5, or we sold it for 12, has an adjusted basis of 5, what would our gain be? What's that? 7,000, right, $7,000 gain. If that was all capital gain, and we got the preferential tax treatment for it, maybe we're in the 15% tax bracket for capital gains. So 7,000 times 15%, 1,050. So the tax is 1,050. Up here, we were in the 22% tax bracket, so $1,100 in tax savings we received. $5,000 of this gain is due to this depreciation that we got. It's at a different tax rate. So the IRS says, well, that's not fair. We gave you the benefit of the ordinary tax rate on this depreciation. You're gonna have to pay when you pay on that gain, you're gonna have to pay us back at that same tax rate, or whatever your current tax rate is. So if it was all capital gain and all of that 7,000 resulted in a $1,050 tax, the IRS says that that's not fair. So what they're gonna do, our gain is still 7,000, but now there are two parts to that gain. There's the part that was attributable to depreciation, and then there's a part that is attributable to appreciation, increase in value of that asset. So the depreciation part is 5,000. The appreciation is 2,000. It's going to be taxed at different tax rates. The IRS is going to say, okay, that's going to be taxed at 22%. Because that's fair, right? You got the deduction at the 22% rate. Now you're going to pay the tax at the 22% rate. This one is the one that's going to be taxed at the 15% rate.
And those percentages are just examples that you made up for this scenario. They
The 20,
could be anything.
yeah, I mean these are actual tax rates,
Right.
but yeah,
But it's just
yeah.
whatever you got on the front.
whatever
you get on
your,
the back.
yes.
Okay.
So this could be, maybe you, like when you were taking the deductions, you were in the 22% tax bracket, but now you're in the 35% tax bracket. It doesn't matter, then this is gonna be at 35%.
Oh, okay.
So it's gonna be at whatever your tax bracket, your ordinary bracket is right now. Yes. So that kind of sucks. However, you could also be in the opposite position. Maybe your tax bracket was 35% then, and you got a tax deduction of 35% of that depreciation, and now you're at the 22% bracket. Right? So your tax rate could change. Your bracket could certainly change between those times. But the crux of it is this 5,000 that it was attributable to depreciation, it's gonna be taxed at ordinary tax rates. The additional $2,000 will get that beneficial tax rate. So in this case, so 5,000 times 0.22, oh, that's right up there. Why am I doing that? 1,100 and 300. So this is ordinary. This is capital gain. So you're paying $1,400 in tax, total. If you sold it for $10,000, all of the gain would be attributable to depreciation. So you wouldn't have this capital gain portion of it. If you had, let's say you sold it for $9,000, you sold it for 9,000. You have a gain of 4,000. All of that is attributable to depreciation. So all of it, your depreciation portion will be 4,000. There's no appreciation, so that's gonna be at the, whatever your ordinary tax rate is. Does that make sense? It's a lot easier to figure out than it seems, because essentially all you have to do is figure out the gain. Whatever portion of that gain, compare it to the depreciation that you took. That's gonna be the amount of the 1245 recapture for equipment. 1250 property, which is the real property, not like real as in it actually exists, but real estate, works the same way, except it's a flat tax rate. We're not gonna use this ordinary tax rate, whatever our ordinary tax rate is. We use a flat 25% tax rate. So that's the difference between the depreciation recapture works the same way though, but that tax rate is different. So for the 1245, it's whatever your marginal tax rate is. For the 1250, it's 25% is the recapture portion. Losses are special though. Losses are all ordinary. So any loss is going to offset ordinary income. It's not a capital loss, and there's no limit to it. So it can offset all the rest of your income, right? So let's see, 1245 recapture, we just kind of went through this. Let me see if there's anything different that they say in here. This is most assets that are used in trade or business with the exception of real property. Most common example, machinery and equipment. Could also include automobiles, livestock, certain buildings placed in service between 1981 and 1986. So there are some special, that's back when they did not have straight line depreciation. So those are kind of special. Don't worry about that. You're not gonna have any problems on those. Any gain recognized on the sale is ordinary up to the amount of depreciation taken, and then anything over and above that is gonna be capital gain. Okay, so here's an example as well. May 2021, taxpayer purchased a truck to be used 100% in a trade or business. 5-year property for $10,000. Using makers and the half-year convention, $6,160 of depreciation was taken. And then it was sold for $7,000. All right, so basis of the truck was $10,000, took $61.60 of depreciation, so its adjusted basis was $38.40, and then they sold it for $7,000. So our gain, our total gain is $3,160. All of that gain is due to depreciation that was taken, right? And as they mentioned here, the 1231 gain is unusual. I'm sorry, this scenario for the 1245 property is unusual because usually stuff like that doesn't appreciate in value, right? You usually have, although you still could because you haven't fully and if it's fully depreciated and you sold it for something, then so what they're talking about here, the 1231 gain is the capital gain portion of it, is usually unusual. So like here, the entire gain is absorbed by that depreciation that was taken. It's unusual to have any appreciation portion of it. So, let's look at this one. So Noor purchased equipment costing $12,000 for business use. Depreciation deducted on the equipment, $7,392. So here's some different scenarios. The adjusted basis of the equipment is $4,608. So here's some different situations. First one, got $13,000 for it. Adjusted basis of this property remains the same for all of these through at the depreciation. 4,608. So the gain in this case is 83.92. Of that gain, here's our depreciation that we took. 73.92 of it is the 1245 portion, because it's going to be up to the depreciation that was taken. The rest of it is going to be a capital gain, 1231. Like I said, they call it a capital gain. It's at capital gains tax rates. Here instead, $9,000. So adjusted basis 4608. The gain on it, 43.92. Again, gain is going to be the where are we here? The adjusted basis 46. The amount realized minus the adjusted basis. There. All of that is going to be 1245 recapture because it's all due to depreciation. Right? In this case, it's a loss. They got $4,000 for it. Their adjusted basis is 4608, so they had a loss of $608. All of that is considered an ordinary loss. They get to offset the rest of all of their income, their ordinary income, with that loss. Okay. Let's see. So, with regard to QBI, Section 1231 assets, short-term and long-term gain or losses are not taken into account in calculating QBI. If the item is not treated as capital, such as Section 1245 recapture, then it is included in the QBI calculation. So it's added. Again, don't worry too much about that. You don't have any problems that go into that. I'm pretty sure you don't. All right. What else do I want to say? What are they doing here? Oh, this is with the QBI calculation. So if they do have to add back QBI. So let's look at this one so you can see how it works. So July 28th, 2023, LMN Company sold office equipment for $6,500. It was purchased May 10th, 2021. Basis was $8,000. It's a Section 1245 asset depreciated over 7-year makers. So accumulated depreciation was $3,802. Adjusted basis $4,198. The gain on the sale is $2,302 because they got $6,500 for it, and their adjusted basis was $4,198. So $2,302. It's considered ordinary income to the extent of the depreciation taken. So it would be added to income to calculate QBI in this case. So here's what that calculation would look like. We'd start with the Schedule C income. We'd subtract out, and this is for purposes of calculating QBI, so we'd be taking 20% of this amount. We'd subtract the self-employment tax, but we would add back the $2,302 because it's being taxed at ordinary tax rates and is included in the business. It's not showing up on the Schedule C, but it's part of the business income. So they're going to include it in the QBI calculation. So they're going to add that in, which is a good thing. 20% of a higher number is better than 20% of a lower number when we're talking about a deduction. So the total amount is going to be based on the 44,123. Okay. So which comes out to 88.25. 1250 recapture. So same thing, just it's at a 25% tax rate. This is depreciable real property used in a trade or business. Okay, so 1250 includes buildings, residential and non-residential, used in a business for the production of income. This one is going to have more appreciation attached to it, right? Which would be capital in nature. So this is, let's see if we have an example of the 1250. So the difference with the 1250 property is that capital gain rate. So most of our capital gain tax rates on everything else, 0, 15, and 20%, but we've got this additional 25% tax rate that's applied to sale of 1250 property that has depreciation recapture associated with it. I think so here we go. We've got a building, basis was 200,000, depreciation 48,296. So the adjusted basis on this is 151,704. Sold it for 275. Now you can see right away, another easy way to calculate this is, we had $75,000 of appreciation, right? We bought it for 200,000. We sold it for 275. It went up in value by 75,000. That's the appreciation or the capital gain portion of it, right? That's the one that's going to get the preferential tax rate. If we subtract the adjusted basis, so the total gain is 123,296. Here they've subtracted the depreciation that was taken, so the gain, this part is going to be taxed at 25%. I'm sorry, yeah, this amount of the gain, I'm sorry, scratch that. $75,000 is going to be taxed at the lower tax rates. The 48,296 is what's going to be taxed at the 25% tax rates. So is what they explain here. The gain is treated as income subject to 25% tax. The lesser of the depreciation taken or the realized gain, so it'd be 48,296, tax rate is 25%, resulting in a tax of $12,074. The remaining $75,000 gain is due to the appreciation in value that qualifies for the 15% tax rates. So 11,250. So you can see the difference in taxes here. Even though it's less income, the 48,296, it's got more taxes attached to it because it's a higher tax rate, right? Okay. So here's another example here. Abe, used a building in a trade or business, purchased 2019 for 165, sold the building June 2023. Straight line depreciation, of course, because it's a building, $16,927 of depreciation. So the adjusted basis 148.73. That calculation there. So independent situations calculate the amount of any gain or loss. In situation 1, if the amount realized was 172, adjusted basis of the building 148,073, that means the gain is 23,927. Of that 23,927, 16,927 is due to depreciation. So that's going to be taxed at 25%. The rest of it is due to appreciation. Makes sense, right? Bought it for 165, sold it for 172. It appreciated in value by $7,000. That's going to be taxed at 15%. Second scenario, sell it for 160,000. So 160,000 means our gain now is 11,927 because we subtract that adjusted basis. That is less than the 16,927 of depreciation we took, which means all of that gain is attributable to depreciation. All of it's taxed at 25%. None of it will be taxed. They would not get any benefit from the capital gains tax rates. In this case, 140,000, less than what their adjusted basis is. That means they got a loss of $8,073. We don't have to worry about the gain stuff. That $8,073 is going to offset other income on their tax return. Wages, their self-employment income, interest, dividends, all that stuff. It's gonna offset all the rest of their income. So whatever their ordinary tax rate is, they're gonna get a tax benefit for that percentage of this amount of money. Let's see. Oh my God, I'm at the end of this. Okay. Let's take a look real quick at the 4797, how this works out. What is this scenario? Oh, this is Noor. Where was that example? Was that? There we go. It must be the first scenario here. So 13,000, this is 1245 property, adjusted basis 4608. Okay. So on the 4797, so we're gonna fill out, like I said, this stuff is entered on the second page of the 4797. So sold equipment for $13,000. Cost paid $12,000 for it, but took depreciation of $73.92. Adjusted basis 4608. Total gain, and they give you how to calculate that here, $83.92. If section 1245 property, it's equipment. If it was 1250 property would go here as well. So if it was real estate, it would also go here, but you wouldn't fill these lines out. 25, you'd fill out lines 26. So depreciation allowed or allowable, again, even if you didn't take the depreciation, you're still gonna get dinged when you sell this. So you might as well take it. Depreciation allowed or allowable, $73.92. Enter the smaller of those two. The rest of it goes down here. So, summary of the part 3 gains. Total gains for all properties. If you had multiple properties, it would all be there. So this is where the netting happens. Okay. Add columns A through D, line 24. Total gain, there, $83.92. Add property columns A through D, lines 25B, 26C, 27C, 28, 29. This is all the depreciation parts. Enter that here on line 31. Subtract line 31 from line 30 is 1,000. So this one, as you see, it says enter here and on line 13. That's on page 1. This one, enter here and on line 6. So line 13 and line 6 on page 1. Here is, oh wait a minute. Say 13, did I get that wrong? Did I get that wrong? Here and on line, oh, I'm sorry, this one. So line 6 goes up here, and then combine those two. So there's your $1,000. And then this one, enter it on line 13. Go through all the gyrations here. Combine lines 10 through 16. So redetermine the gain, schedule, and then enter this on schedule 1. Part 1, line 4, this is other income. It's going to be taxed at ordinary tax rates. This actually gets thrown, they don't say it here, but this gets put on the schedule D because this is at a capital gains tax rate. This is going to transfer over to the schedule D. Let's see, did they give us that, schedule D? No, they didn't. Let me see if I can pull up a schedule D and show you where that would go. actually, I think this should be subtract line 8, what is 8? Non-recaptured, no, subtract line 8 from 7. 0, if 9 is 0, enter the gain from line 7. If more than 0, enter the amount from line 8. On line 12 below and enter the gain from line 9. As long-term capital gain on the Schedule D filed with your return. So I think this 1,000 actually probably should be entered here on line 9 as well. Let's see. So that's 0 on line 12, so that's fine. Enter the gain from line 9 as a long-term capital gain on Schedule D. Yeah, I think it should be here too. They missed that. And then this is where it would go here. But the other part of that gain would not go there. That's 73.92. That's gonna go on the Schedule 1. Part 1, other gains and losses. So what is it, 73.92? 73.92. That would go there. Okay. Questions?